My name is Dennis Blitz with the IRA Club, and today we're going to talk about Roth IRAs and Roth solo 401ks. The rules are almost identical for the two of them, so we'll put them together, Roth IRAs and Roth solo 401ks. Here we go. So a Roth IRA, I want to just say this at the very beginning, Roth IRAs and 401ks are the best gift Congress has ever given to the average taxpayer. Yeah, sure, if you're a big pharmaceutical company or you're, General Motors or an airline, yeah, you're probably going to get some better deals from Congress. But for the average taxpayer, this is the premium opportunity. So let's talk about just the basics first. Let's talk about how traditional IRAs and Roth IRAs vary. Okay, now in a traditional IRA, at the time of the contribution, you get a deduction for the amount you contribute. And with a Roth IRA, you do not. So how does that work? So let's say you make $50,000 a year and you contribute $5,000 to your traditional IRA. You'll pay income tax like you made only $45,000. You get a deduction for your contribution. And with a Roth IRA, you don't get a deduction for your contribution. If you made $50,000, $5,000 contribution to a Roth, you still pay tax like you made $50,000. So far, it doesn't sound like a Roth IRA is a very good idea, does it? Let's go on. Let's take a look at what happens on the internal growth while that money is invested. Let's see. It grows income tax-free in a traditional. That's great because you understand compounding and the value of compounding. It really accelerates when there's no tax. And in a Roth IRA, it also grows income tax-free. So on internal growth, they're both equally good. Now, let's get to the time when it's time to take a distribution, take the money back out. On a traditional IRA, is the distribution income tax free? And no, it's not, because you didn't pay tax going in, you didn't pay tax on the growth. You're going to pay income tax at the time of you take your distribution. With the Roth IRA, is the distribution income tax free when you take it out? And it is. So wait a second. When do you want the tax benefit? Do you want it at the very beginning, or do you want it at the end after the asset has grown? After the asset has grown, that tax benefit will be far more valuable to you. And so that's the beauty of the Roth IRA. It's a tremendous impact, as we'll see. What happens if my investment never grows? Then I wasted my money. Not really, because what happens if tax rates go up? If tax rates go up, I'm still better off in the Roth because I paid the tax rates at the current lower rate. Okay, so let's go on. So I'm going to pause here because not everybody likes this chart. Not everybody wants to see the chart, and I'll tell you the truth. I have a very good friend, very intelligent person. He just never got it, right? And we talked, and I knew that he grew up in Las Vegas. And I said, gee, how can I make this clear for somebody who grew up in Las Vegas? So I've made another chart, and hopefully this will help you visualize the benefit of a Roth IRA. There we are. So when do you want your benefit? You want it at the end. Why is the benefit so valuable at the end? Because there's more cherries. Your assets had time to grow. And so Roth IRAs save tremendous amounts in taxes, and we're going to see a lot more benefits to it as we move along. Let's do a snapshot of Roth IRA benefits. You can make almost any investment you want for your future. The earnings inside the Roth are income tax free. The total proceeds at the time of distribution from a Roth can be income tax free. And all you have to do is attain the age of 59 and a half, and it's been a Roth IRA for 5 years. And Roth IRA tax treatment transfers to your beneficiary. We're going to see how valuable this is coming up here. But if you start a Roth IRA and get all those tax benefits for yourself, but you pass away, you pass not only the IRA to the beneficiary, you pass your preferred tax treatment. And we'll see the value of that in a second. And lastly, Roth IRAs, like any other IRAs, can partner. to make larger investments. And see our video on partnering to get an idea about that. Okay, let's go on. So what types of plans can I convert to a Roth? In other words, I have a traditional right now. Can I convert it to a Roth? Yeah, you can convert a traditional IRA to a Roth. You can convert a SEP IRA to a Roth. You can convert a retirement plan from a former employer to a Roth. You could even convert your solo 401k to a Roth. So Roth IRAs have all these advantages, and they're easy to convert to. Understand that conversion is a taxable event, but again, once you pay that tax, you've stopped all the taxes going forward. Very, very valuable. One of the questions that people ask about Roths is, wait a minute, I don't know if I want to do this because my money is tied up until I'm 59 and a half. Well, wait a minute, no it's not. Yes, to get all the tax benefits, 59 and a half. But what happens if I want to take money out before 59 and a half? If I have to take money out before 59 and a half, can I do that in a Roth IRA? And the answer is yes, you can. As a matter of fact, if you start a Roth IRA on Tuesday and you want to take money out on Wednesday, no problem. So you don't have to wait till you're 59 and a half. You can take it out anytime you want. And there's a big benefit. The big benefit is Roth IRAs use something called FIFO accounting. And for those of you who are not familiar, what's FIFO accounting? First in, first out. And you'll see this is a big benefit to a Roth IRA owner. So let's take a look at a sample. We've got a client, let's say his name is Bob. And 18 months ago, Bob had a traditional IRA, had $90,000 in it, and he decided to convert to a Roth. He was going to make an investment. He decided the investment's going to be pretty good, it's going to grow. Let me pay the tax on the 90 before the investment grows. And that's exactly what he did. Now, again, that conversion was a taxable event, but the tax was just on the $90,000. Now, when the conversion was complete, Bob made an investment with his Roth IRA. And now he sells the investment for $168,000. Is Bob happy? Sure. He made an investment for 90. 18 months later, he sold it for 168. He only paid tax on the 90. He'll never pay tax on that 168, he figures. Then something happens. Life happens. And Bob has a personal event, and he could really use $65,000. However, his money is tied up in this Roth IRA, and he's not 59 and a half. But he's got to have that $65,000. So Bob calls our office and he says, hey, I need to take out $65,000. I know I'm not 59 and a half, and I know I'm going to get clobbered with taxes because I'm doing it. But that's not what's going to happen. What's going to happen is this. Bob requests the $65,000. We'll send it to him the next day. Now, which $65,000 did Bob take? Was it from the $90,000 that he originally invested? Or was it from the profits that the IRA earned? Well, remember, it's FIFO, first in, first out. That money that he took out was from those first dollars. Remember, he already paid taxes on the conversion. So he's already paid the income tax on that first $90,000. He's only taken out $65,000. Will there be an income tax bill for him to take the distribution? And no, there won't. The taxes are already paid. So you can take out the full amount that you contribute without a taxable event because of first in, first out. Now, had Bob waited till he was 59 and a half, then everything would have been not only tax-free but penalty-free. There is a penalty for early distribution, and I will tell you that the penalty is simple and easy, and it's not too onerous. It's 10%. If you need the $65,000, well, you need the $65,000. You'll pay the 10% penalty. Very, very liberal opportunities for you to not only make money tax-free if you wait till you're 59 and a half, but also very liberal opportunities on getting the money out even early. Okay, so reviewing the IRA, we have two opportunities. Number one is at 59 and a half and holding it for 5 years, 100% tax-free distributions back to you, and favorable opportunities if I have taken early distribution. But there's more. A Roth IRA remains a Roth IRA even if you die. What's that mean? What it means is this. What it means is if you have a Roth IRA and you're going to get all these tax benefits when you retire and you start taking distribution, but you die, what are you leaving to your beneficiary? You're leaving not the assets in the IRA, you're leaving the IRA. And that means your beneficiary inherits your tax benefits also. So even your beneficiary can take out that Roth IRA without income tax. Tremendous opportunities for huge tax savings with a Roth IRA. Okay, so let's compare how that's going to work. I've got two clients here. One is Arnold and the other one is Anna. And Arnold has a traditional IRA. He has, and I've got lots of Arnolds in our company. So Arnold has been very cautious, he's been very careful, he's been meticulous, and he's taken that IRA and he's invested in single-family homes that are paying rent. He likes the way he structured his IRA. He's got 12 single-family homes in that IRA. He's got, his beneficiaries are named, they're his 2 adult children. His 2 adult children now suddenly find they're the owner of the IRA because Arnold passed away. And the children talk and they say, you know what? We don't want this IRA. We don't want these houses. We want to turn it into cash right now. And so that's exactly what they do. They liquidate, they sell the houses in the IRA and then they liquidate the IRA. Because Arnold had a traditional IRA, when they liquidate that IRA, is it a taxable event to the children? And yes, it is. It was a traditional IRA. However, now let's take a look at Anna. Anna has done exactly the same thing. She has a Roth IRA instead of traditional. She too cultivated it nice and neatly. She too has 12 homes earning a profit in that IRA. She's very happy, and she also named her 2 adult children as the beneficiary. Anna passes away. And her 2 adult children do exactly what Arnold's children did. They say, you know what, we don't want this IRA, we don't want these houses, we want the money now. Well, they want it. So they sell the houses in the IRA and they liquidate the IRA. How much tax do they pay on the liquidation of that IRA when they get that cash? None. It was a Roth IRA. So you can leave your heirs a traditional IRA, they will have a taxable event, or you can leave your heirs a Roth IRA and they've avoided the taxable event. So tremendous value to the liquidation and the beneficiary getting your Roth IRA, and those 2 kids of Anna are both saying, thanks, Mom. You know, Arnold's kids are saying thanks too, but they're saying thanks a little more quietly because they paid a big tax bill. So again, now let's review again. No tax on the distribution after just 5 years and age 59 and a half. If you take an early distribution, very, very favorable tax treatment on early distributions. And lastly, that Roth treatment goes to the heirs. It's a wonderful opportunity to have a Roth IRA as opposed to traditional. If you're thinking about it, consider carefully. So what kind of plans can you convert to a Roth IRA? Well, you can convert a traditional IRA to a Roth IRA. You can convert a SEP to a Roth IRA. You can convert an old retirement plan from a former employer to a Roth IRA. You could even convert a solo 401k to a Roth IRA. So very, very liberal on conversions. You're getting the idea that these are very liberal, they're very powerful because of the tax treatments. So let's talk about the Roth conversion, and it's a taxable event. Okay, wait a minute, it's a taxable event. Do I really want to do this? Okay, so what is the tax based on? The tax is based on the value of the IRA that you're converting. So if you're converting a traditional IRA, a Roth, a SEP, whatever it is, we simply base everything on the value. Now I say value because a lot of people think that we can only convert cash, but not so. You can convert cash or assets, cash and assets. So let's say I have this many dollars in my traditional IRA and I own a house in my IRA. Can I convert them both, traditional IRA? Can I convert them both to Roth? Yes. we do have to put a value on the house. We can't just make up a number. We put a value on the house. And the way we typically do that is we simply order out an appraisal. And that appraisal becomes the value of the house. And so we can convert both assets and cash. We generally want to appraise the asset so that we have a good hard value for the Internal Revenue Service if they ask how we came up with our numbers. So when is the tax due on a Roth conversion? Well, it's not due in most cases until next April 15th. So let's say you did a conversion in January or February or March. When is the tax due on the conversion? Next year in April 15th. So you've got a long time till the tax is even due. Now, how do you pay the tax? Well, some people do take the money out of their IRA to pay the tax, and that's fine. But most people just simply add it to their tax bill and pay it with their own dollars. What's the effect of that? The effect of that is it keeps all the money in the IRA growing for your future and growing for a tax-free future. So if you can pay that tax with your own dollars, boy, that's a much, much better deal. Okay, let's go on. Does the IRA Club charge to do a Roth conversion? Well, we know the government has the tax on the conversion, and the IRA Club does charge to do a conversion. Are you ready? Here we go. To do a cash conversion, it's $15. That's it. And you could make tens and tens of thousands extra because of no tax because of it. It's well worth the $15. All right, let's ask another question. Must I convert all my IRA at once? And no. You can convert however you want. Now, most people do convert all at once. However, you can convert over a period of time. Some people want to convert half this year and half next year to spread out the tax bill. Some people a third, a quarter. However you like, you can make that conversion. You can do two conversions, say, I don't want to do any more conversions, fine, no problem. Very, very flexible. You can break it up. I want to tell you right now, you may want to convert a little sooner than later, only because which way your tax is going. They're going up, and every conversion could be more expensive because of it. You want to convert as soon as possible. Let's talk about why people convert. Why people convert, and if the conversion is going to be taxed at my ordinary income tax rate, why would I even do this? Why would I convert? But this sounds like a real penalty. Well, again, you want to pay tax now. You want to pay tax on the seed as opposed to waiting till it grows into a tree. The better the investment opportunity you have, the earlier you want to pay that tax. So paying tax before it grows into a whole apple tree is the best time to pay the tax. Okay? The next reason is, what if taxes are higher in the future? Right? You want to pay taxes as early as possible to avoid the higher taxation in the future. Many economists say that the risk of higher taxes is a greater risk than the investment opportunity risk. Pay your taxes early if you think they're going up in the future, because at the rate we're going, they're going to take all your money in taxes. We know that. So let's see, maybe, and lastly, you want that Roth tax treatment to go to your beneficiaries. You want to be able to leave your heirs a Roth if you can. So if you're starting a new IRA, you would just start it as a Roth. Okay, so here we are. I want you to think about a Roth conversion. Contact the IRA Club if you have any questions, and we'll talk about all the opportunities you have, because with a solo 401k, a solo IRA, you have endless opportunities. We have a whole staff of people happy to answer your questions, very knowledgeable. They'll answer any questions you have. Thank you very much. Hope to see you soon.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.